Upbeat, engaging intro music fades slightly into the background. Hey everyone, and welcome back to the channel. Let's talk about something that gets everyone fired up: taxes. You work hard, you pay your share, but then you hear these stories about the ultra-wealthy, legally paying next to nothing. It sounds like something out of a movie, right? But what if I told you it's very real, and it all comes down to understanding the rules of the game? Today, we're pulling back the curtain. We are going to break down exactly how the rich are positioning themselves to legally pay as little as 0% in taxes, especially with some big changes on the horizon for 2025. This isn't about finding shady loopholes, this is about financial literacy. By the end of this video, you'll understand the strategies they use. Not so you can evade taxes, but so you can apply the same principles to your own financial life, no matter your income level. Ready to level up your financial knowledge? Let's dive in. First, we need to get one crucial concept straight: the difference between income and wealth. Most of us earn income from a job. We get a paycheck, taxes are withheld, and that's that. This is called earned income, and it's taxed at the highest rates. The wealthy, however, often have very little income in this traditional sense. Instead, their financial world revolves around assets, stocks, real estate, businesses, art. This is their wealth. They don't get a W-2 from their stock portfolio. So, how do they live lavish lifestyles without a giant salary? The answer is a powerful tool: leverage. Instead of selling their assets to get cash, which would trigger a capital gains tax, they borrow against them. Banks are more than happy to lend them millions at very low interest rates, using their stocks or properties as collateral. This loan isn't income, so it isn't taxed. They get all the cash they need to live on. Their assets continue to grow in value, and they haven't paid a single dollar in tax. This strategy is famously known as buy, borrow, die. Let's break down that buy, borrow, die strategy a bit more because it's the absolute cornerstone. Step 1. Buy is simple. They acquire appreciating assets. These are things that are expected to increase in value over time, like a diverse portfolio of stocks or a commercial real estate building. Step 2 is borrow. As we just discussed, once these assets have grown in value, they take out low-interest loans against them to fund their lifestyle. This is their tax-free income. Now, for the final, and perhaps most mind-blowing part: die. This sounds grim, but it's a purely financial term. When the wealthy individual passes away, their heirs inherit these assets. And here's the magic trick. Thanks to something called the step-up in basis, the original cost of the asset is stepped up to its fair market value on the date of death. Let's say someone bought a stock for $1 million, and it's worth $20 million when they pass. Their heirs inherit it at a new cost basis of $20 million. If they sell it the next day for $20 million, their taxable gain is zero. That original $19 million of growth, it was never, ever taxed. The entire cycle can then begin again. Now, let's talk about real estate, because it's a supercharged vehicle for tax reduction. When you own investment properties, the government allows you to claim depreciation. This is a non-cash deduction, meaning you don't actually spend any money, but you get to subtract it from your rental income. The IRS basically says, your building is getting older, so we'll let you write off a piece of its value each year. For a commercial property, this is done over 39 years. But the rich use a strategy called cost segregation. They hire engineers to do a study that breaks down the property into its components: carpeting, fixtures, landscaping, which have shorter depreciation schedules, like 5, 7, or 15 years. This front-loads the depreciation, creating massive paper losses in the early years of owning a property. These losses can then be used to offset other income, including, for high-earning professionals who qualify, their regular job income. So, you could make $1 million as a surgeon, but your real estate losses on paper could wipe out your entire tax bill. You're still collecting rent, and your property is still growing in value, but for tax purposes, you've lost money. Another powerful tool in the arsenal is the Roth IRA, or, more specifically, for high earners, the backdoor Roth IRA. A Roth IRA is incredible because you contribute after-tax money, but it grows completely tax-free, and all qualified withdrawals and retirement are, you guessed it, tax-free. The problem is, there are income limits to contribute directly. So, the wealthy use the backdoor method. They contribute to a traditional, non-deductible IRA, which has no income limits. Then, almost immediately, they convert that traditional IRA into a Roth IRA. They'll pay a small amount of tax on any tiny gains made in that short window. But once the money is in the Roth, it's shielded from taxes forever. Tech billionaire Peter Thiel famously used a variation of this to turn a few $1,000s in his Roth IRA into a $5 billion tax-free war chest by investing in startups within the account. While that's an extreme example, the principle is the same. Get money into a Roth vehicle where it can grow and be withdrawn without ever being taxed again. It's a long-term play for a 0% tax rate in retirement. But what about giving back? Surely they pay tax then. Not necessarily. Charitable giving is one of the most effective and publicly acceptable ways the wealthy reduce their tax burden. But they don't just write checks. They often use something called a donor-advised fund, or DAF. Think of it like a personal charitable savings account. They can donate appreciated assets, like stocks they've held for over a year, directly to the DA. Here's the double benefit. First, they get an immediate tax deduction for the full market value of the stock, not what they originally paid for it. Second, they never have to pay the capital gains tax on the growth of that stock. The DAF sells the stock tax-free, and the donor can then recommend grants to their favorite charities over time. So they get a massive tax write-off today, avoid capital gains, and get to be philanthropic on their own schedule. It's a huge win-win from their perspective, allowing them to support causes they care about while dramatically lowering their taxable income. Now, let's bring it all together and look ahead to 2025. Why is that year so important? Because many of the tax cuts enacted by the Tax Cuts and Jobs Act of 2017 are set to expire. This means tax rates are scheduled to go up, and the lifetime gift and estate tax exemption is set to be cut in half. For the wealthy, this is a major deadline. They are currently using strategies like gifting to move assets out of their estates before that exemption amount drops. By gifting assets to family members or trusts now, while the exemption is high, they can pass on tens of millions of dollars completely tax-free, ensuring that wealth is protected from future estate taxes. They are also locking in certain tax strategies before the rules potentially change. This is a period of intense activity for their accountants and lawyers, as they work to maximize the benefits of the current tax code before it sunsets. It's a reminder that tax law is not static, and the most successful people are always planning years, even decades, ahead. So, after hearing all this, you might be feeling a bit frustrated, and that's understandable. It can seem like there are two different sets of rules. But my goal here isn't to make you angry. It's to empower you. You don't need to be a billionaire to apply these concepts. The core principles are universal. First, start thinking in terms of assets, not just income. Focus on acquiring assets that can grow in value, whether it's stocks through a low-cost index fund, your first rental property, or even starting a small side business. Second, prioritize tax-advantaged accounts. Are you maxing out your 401k or your IRA? If you have access to a health savings account, or HSA, it's a triple tax-advantaged powerhouse. The money goes in tax-free, grows tax-free, and comes out tax-free for medical expenses. It's one of the best tools available to everyday investors. The lesson here is to shift your mindset from being just a consumer and an earner to being an owner and an investor. The tax code, whether we like it or not, incentivizes ownership and investment. By understanding these incentives, you can start making them work for you, instead of just against you. Educate yourself. Read books on investing and personal finance. Listen to podcasts, and most importantly, take action, even if it's small. Your first $100 invested in an S&P 500 index fund is your first step toward building wealth like the rich. Your first conversation with a financial advisor about a Roth IRA is your first step toward a tax-free retirement. It's about playing the long game and using the rules to your advantage. Every journey starts with a single step, and your financial freedom journey can start today. Don't let the complexity stop you. Start small, stay consistent, and build your knowledge base. You have the power to change your financial future. Thank you so much for sticking with me through all of that. I know it was a ton of information, but I truly believe that financial education is the key to unlocking a better future for yourself and your family. If you found this video helpful and it opened your eyes to some new ideas, please do me a huge favor and hit that like button. It really helps the channel reach more people who need to hear this message. And if you haven't already, make sure to subscribe and ring that notification bell so you don't miss our next video. We're going to keep breaking down these complex topics to make them simple and actionable for you. Leave a comment below with your biggest takeaway or any questions you have. I read every single one. Thanks again for watching, and I'll see you in the next one.